There are 5 specific IRS forms that the average American senior born before 1971 has never filed, not once, in their entire life. And every single one of them could put thousands of dollars back in their pocket before June 30th. 5 forms, sitting on the IRS website right now, completely free, available to every senior born before 1971. And the overwhelming majority of people who qualify are not using them, because the overwhelming majority of people who qualify have never been told they exist. Before I go a single sentence further, I need to address the one misunderstanding that causes most seniors to tune out of a video like this before it ever gets going. Because that misunderstanding is the reason so many people walk away from money that was legally theirs to begin with. Some people hear IRS forms and immediately think that is for seniors who are financially struggling. I'm doing okay, so this probably isn't for me. They close the tab. Others assume it is some high-level wealth strategy only relevant to retirees with complex investment portfolios. I'm mostly living on Social Security, so I'll skip it. They close the tab too. Both of those assumptions are completely wrong, and both of them are costing people real money. This list is for every senior born before 1971. It does not matter whether your entire monthly income is a Social Security check or whether you have a pension, a savings account, and a home that has tripled in value since you purchased it. Real money is sitting inside these 5 forms with your name on it. And the only thing standing between you and that money is knowing the forms exist and taking 20 minutes to file them. The reason almost no one explains this to you is pretty straightforward. The IRS does not run advertising campaigns about ways to reduce your tax bill. Your CPA or tax preparer does not receive a bonus for finding forms you could have filled out yourself. And the deadlines are real. June 30th is not an arbitrary date on the calendar. For several of these forms, letting that date pass means waiting an entire additional year to recover money that is already legally yours right now. So today I am going through all 5 one at a time in plain English. Form number 1 is coming up in just a few minutes, but I need you to stay through to the very end because Form 5 is the most powerful entry on this entire list. It is the one that almost no senior has ever heard of. It has the highest dollar impact per month of anything I am about to share. And for many of you, it could change your monthly finances starting as soon as next billing cycle. The truth about why these forms go unfiled. Here is the uncomfortable reality behind all of this. The IRS will not call you to file these forms. Your tax preparer does not automatically include them in a standard return. Every form on this list either reduces what you owe or puts money back in your hands faster, which means the systems that collect your money have very little financial incentive to remind you they exist, and absolutely no legal obligation to bring them to your attention. Think about it clearly. Every dollar you do not claim is a dollar that stays in the system. That is not a conspiracy. That is simply how a passive tax code functions. It rewards the people who know to act on it. It quietly takes from the people who do not. And there is a second reason these forms go unfiled year after year. Most seniors were raised to believe that anything involving the IRS should be handled carefully and delegated to a professional. So they hand their paperwork to whoever charges the least, sign wherever they are told to sign, and trust that everything important is being caught. The problem with that approach is hope is not a tax strategy. If you have ever found yourself wondering whether your tax preparer is actually filing every form you qualify for, drop a comment below right now. Your answer helps me understand who is being well served by the system and who is being quietly failed by it. Quick but important note, this video is for educational purposes only and is not tax or legal advice. Tax law is genuinely complex, and your individual situation has details that matter. Always consult a licensed CPA or enrolled agent before taking any action based on what you learn here. Now, before Form 1, here is something I want you to keep in mind for the next several minutes. At the end of this video, I am going to walk you through a real-life scenario in which one of these 5 forms saved a retired couple in Arizona more than $5,000 in a single year, starting the very month after they filed. They had never heard of the form. Their financial situation had changed dramatically, and nobody told them the correction existed. Stay with me. Every form I'm about to cover has been verified directly through irs.gov or ssa.gov. I will give you the exact form number, its exact purpose, and exactly where to find it so you can confirm everything yourself before you do a single thing with it. Nothing here is speculative. It is all real, and it is all waiting for you to claim it. Form 1. W4P. Stop overpaying on your pension and IRA distributions. Form W4P is the single most overlooked form in the entire IRS catalog, and it is the one that puts cash back into your hands the fastest once it is filed. Available free at irs.gov, this form controls how much federal income tax is withheld from your pension, annuity, or IRA distributions every single month. Here is the core problem. When most pension programs and IRA custodians set up monthly distributions, they either apply a default withholding rate that is almost always set too high, or they run a generic calculation that assumes you have more taxable income than you actually do. The result is the same either way. Every month, they hold back more than you actually owe. Then April arrives, and you receive a refund. And most people genuinely feel good about that refund. It feels like found money. But here is what that feeling is actually costing you. That money was yours the entire time. Every month, all year long, you handed the government an interest-free loan. And you never saw a single penny of interest for lending it. Let me make that tangible. Take a retiree we'll call Harold. He is 66 years old, single, living in Georgia with a $38,000 annual pension. His custodian withholds 10% automatically. That is $3,800 held back every year. But because Harold is 65 or older, with the additional standard deduction for seniors and the new senior bonus deduction now available, his actual federal tax liability on that pension is closer to $1,400, not $3,800. That is a $2,400 gap. $200 per month that should be sitting in Harold's bank account and is instead parked at the IRS, earning him nothing, waiting for April to be returned. Form W4P is how he corrects that. He downloads it from irs.gov, works through the withholding worksheet, and submits it to his pension administrator or IRA custodian. His withholding adjusts the following month. Not next filing season, the very next month after it is processed. That is one of the fastest acting forms on this entire list. Quick question for the comments. Are you currently having federal tax withheld from your pension or IRA distributions? A simple yes or no helps me enormously. I am developing a follow-up video specifically focused on how to calculate the right withholding amount for different retirement income scenarios. And your response tells me exactly how many people need that breakdown. Form 2, W4V, get your Social Security withholding. Right, Form 2 is for anyone currently collecting Social Security, and it is the form that determines whether the government holds your money for a full 12 months and returns it as a refund, or whether you receive exactly the right amount deposited into your account every single month of the year. Here is something that surprises a lot of people. Social Security payments arrive with zero federal tax withheld by default. Not 5%, not 10%, zero. For some seniors, that is perfectly appropriate. If your combined income falls below the threshold where any portion of your Social Security becomes taxable, then zero withholding is the right answer. But for millions of seniors born before 1971 whose Social Security benefit is at least partially taxable, that automatic zero creates a very unpleasant April surprise. They owe more than they planned for, sometimes considerably more, and in certain situations, they get hit with an underpayment penalty on top of the tax bill itself, all because they did not know Form W4V existed. This form lets you choose your own Social Security withholding rate. There are exactly 4 options: 7%, 10%, 12%, or 22%. You select the rate that most closely matches what you actually owe based on your total income picture, and the withholding is applied going forward. Now, I want you to hear both sides of this because the problem cuts in two directions. Some seniors are under-withheld. They face a surprise bill every April that they had no way to anticipate or plan for. But some seniors are significantly over-withheld. They selected 22% several years ago when their income was higher, and now their actual effective tax rate is nowhere near that level. They are overpaying by hundreds of dollars every single month without realizing it. Consider a woman we'll call Dorothy. She is 70, married, and she and her husband both collect Social Security. Their combined annual benefit is $34,000. Her husband set up 22% withholding years ago when their income was substantially higher. Today, with their current deductions and reduced income level, their actual tax rate on that Social Security income is closer to 9%. They are over-withheld by approximately $2,200 per year. That is more than $180 every single month that should be in their checking account right now, paying for groceries, prescriptions, utility bills, instead sitting at the IRS waiting to be refunded next spring. A new Form W-4V submitted to the Social Security Administration corrects it immediately. You can file it online through your My Social Security account at ssa.gov, mail it to your local Social Security office, or deliver it in person. Once processed, your withholding adjusts going forward from that month. Form 3, 1040-SR, the tax return, built specifically for you. Before I give you Form 3, I want to pause and tell you something important about this list as a whole. 2 of the 5 forms were designed specifically for taxpayers aged 65 and older, not for the general public, not for working adults filing standard returns, specifically for people born before 1971 who have reached or are approaching that age threshold. Form 3 is the first of those 2. Form 1040-SR is the senior version of the federal income tax return. The IRS built it from the ground up for taxpayers aged 65 and older, and millions of seniors still file the standard 1040 every single year without ever knowing that a form designed specifically for their situation exists. Yes, the 1040-SR has larger print. That is a practical benefit that matters for a lot of people. But the print size is not the point. What actually matters is what is built into the structure of the form itself. The 1040-SR has a dedicated section for calculating the additional standard deduction available to seniors age 65 and older. It has a cleaner, more intuitive layout for reporting Social Security income and pension distributions, which are the 2 most common income sources for people in your age group. And critically, it includes the built-in sections for the senior bonus deduction that many tax preparers and software programs simply do not flag automatically when using the standard 1040. Could you technically claim everything on the regular form? Yes. But the 1040-SR puts the deductions and income categories most relevant to your specific situation directly in front of you, rather than buried inside schedules and worksheets that a standard working age filer would never need to touch. Here is your action step. If you use a CPA or tax preparer, ask them one specific question before you sign your return this year. Are you filing my return on Form 1040-SR? If the answer is no, ask them to explain why they chose the standard 1040 instead. If they cannot give you a clear, specific reason, that is a conversation worth pursuing further. If you file your own taxes using software, look for an option to switch to the 1040-SR before you submit. Most major programs support it. It may appear under Senior Return, or it may activate automatically once you confirm your age in your profile settings. Form 4, 8606. Stop being taxed twice on the same dollar. Form 4 is the one that prevents you from handing the IRS money you have already paid them once. And it is the one that retirees with IRAs are quietly losing tens of thousands of dollars to without ever knowing it happened. Not because of anything complicated or deceptive, simply because one number was never properly tracked. Here is the background. When most people contribute to a traditional IRA, those contributions are tax deductible. You put money in, it lowers your taxable income for that year, and you pay tax when you take distributions later. The tax treatment is clean and straightforward, but some people, particularly those whose income in certain years exceeded the deductibility income limits, made what are called non-deductible IRA contributions. They put after-tax money into the account, money they had already paid income tax on, money that should never be taxed again when it comes back out. Here is the problem. If no one properly tracks that after-tax amount, which is called your IRA basis, then when you begin taking distributions in retirement, the IRS treats every dollar leaving the account as though it were pre-tax money. They tax it again. You have just paid income tax on the same dollar twice, once when you earned it and once when you withdrew it. And there is an excellent chance you have no idea it is happening. Let me put real numbers on it. A retiree we'll call Robert made $45,000 in non-deductible IRA contributions over the course of his working years. He never filed Form 8606 consistently, and neither did the accountant he relied on during that period. Now he is 68 and taking required minimum distributions. Because there is no documented basis on file with the IRS, his IRA custodian reports the full distribution as taxable income. He is being taxed on $45,000 that he already paid tax on at a 22% federal rate. That is $9,900 in taxes he never should have owed, gone permanently, unless he or his current accountant takes steps to address it. Form 8606 is how you document your IRA basis. It is filed as part of your annual tax return for any year you make a non-deductible contribution. And here is what most people do not know. If you have made non-deductible contributions in past years without ever filing this form, you can file amended returns to establish and document your basis going back to those contribution years. It is not too late. This form is also essential if you have ever done or plan to do a backdoor Roth conversion, where you contribute to a traditional IRA and then convert those funds to a Roth. Without Form 8606 on file, the IRS has no record that the original contribution was non-deductible. The conversion appears fully taxable on paper when it should not be. You end up paying tax twice on money that was already taxed once. If you have contributed to a traditional IRA at any point in your working life, and you are not completely certain that every single one of those contributions was deductible, this is a conversation to have with your CPA and to have it before June 30th. Form 5. SSA-44, the most powerful form on this entire list. Pay close attention to what comes next, because Form 5 carries the highest dollar value of anything I have covered today for the seniors who qualify. I told you at the beginning of this video that there was one form almost no senior knows exists. This is it. I want to be upfront about something before I walk you through it. There is a part of explaining this clearly that feels like talking myself out of a job, because the more plainly I lay this out, the less you need someone like me to help you navigate it. But here is my honest position. You earned this money over a lifetime of work. You should not have to pay a professional $300 to file a free government form that takes 20 minutes to complete. To understand why this form matters so much, you first need to understand something called IRMAA. IRMAA stands for Income-Related Monthly Adjustment Amount. It is a Medicare surcharge, an additional fee layered on top of your regular Medicare Part B premium that applies to beneficiaries whose income exceeds certain thresholds. Here is how it works in 2026, based on data from the Centers for Medicare and Medicaid Services at cms.gov. The standard Part B premium in 2026 is $185 per month for most beneficiaries. But if your income from 2 years ago, specifically from your 2024 tax return, exceeded certain levels, Medicare is charging you significantly more than that right now. For single filers, IRMAA surcharges begin once your modified adjusted gross income exceeds $106,000. The first surcharge tier adds $74 per month to your premium. As income climbs through higher tiers, that additional charge rises, all the way up to $443 per month per person at the top tier. For married couples filing jointly, the income thresholds are doubled, and the surcharges apply to each spouse separately, meaning the potential combined annual cost to a married couple can be substantial. Here is the trap that catches retirees specifically, and it is the part that almost nobody figures out without someone explaining it directly. Medicare does not look at your current income. It looks at your income from 2 years ago. So if you retired in 2024 and your income that year was elevated because you worked for the first 6 or 8 months of the year, or because you sold a business, or took a large IRA distribution, or received a pension lump sum payout, Medicare used that elevated 2024 income to set your 2026 premiums. Even though your income dropped sharply when you retired, even though you are now living on Social Security and perhaps a small pension that is a fraction of what you brought home in 2024, you are still paying a surcharge based on income you no longer have and will never have again. That is not a fair outcome. And the Social Security Administration, which manages Medicare premium billing, built a specific correction mechanism into the system to address exactly this scenario. That correction mechanism is Form SSA 44. Form SSA 44 is a life-changing event appeal. It is how you formally notify Social Security that your financial circumstances have changed and request that they use your current income level to calculate your premium rather than the 2-year-old figure that no longer reflects your reality. There are 8 qualifying life-changing events that make you eligible to file Form SSA 44. 1. Marriage. 2. Divorce or annulment. 3. Death of a spouse. 4. Work stoppage, meaning retirement. That alone qualifies. You stopped working. That is it. 5. Reduction in work hours or income. 6. Loss of income-producing property, such as a rental property you no longer own. 7. Loss of pension income. 8. Receipt of an employer settlement payment in a prior year that temporarily inflated your reported income. The Arizona couple who saved over $5,000 in 1 year. Now let me deliver on the story I promised at the very beginning of this video. Frank and Carol are both 67 years old, retired, and living in Arizona. Frank left his engineering position in June of 2024. Carol retired from her school district job in July of 2024. For the months they worked before retirement, their individual incomes were elevated. Frank's modified adjusted gross income for 2024 came in at $138,000. Carol's came in at $122,000. Because Medicare uses your income from 2 years prior to set your current premiums, both Frank and Carol were hit with IRMAA surcharges in 2026, based on the elevated 2024 figures from the year they retired. Frank landed in the second IRMAA tier, adding an extra $259.20 per month to his Part B premium. Carol landed in the first tier, adding $74 to hers. Together, they were paying over $330 per month in combined IRMAA surcharges on top of their standard premiums. Here's the problem with that. Their actual 2026 income, Social Security for both of them, plus a modest pension from Carol's school district, came to approximately $52,000 combined. They were paying premium surcharges calculated from income they had not earned in nearly 2 years and would never earn again. Frank filed Form SSA 44, checked the work stoppage box, and submitted documentation showing his projected 2026 income. Carol filed the same form for her own Medicare account. Both included supporting documentation reflecting their current financial reality. The Social Security Administration reviewed both appeals. Frank's premium was reduced back to the standard rate. Carol's was reduced back to the standard rate. Their combined monthly savings came to over $330 per month. Annualized, That is more than $3,960 in premium savings. And because they filed early in the calendar year, they were able to recover surcharges that had already been deducted going back to January. Their total savings for the year exceeded $5,000 for the couple combined. One form each, available for free at ssa.gov. Approximately 20 minutes to complete per person. Over $5,000 recovered. How to get Form SSA-44 and what to expect. Form SSA-44 is available directly at ssa.gov. You can submit it online through your My Social Security account, mail it to your local Social Security office, or bring it in person to the nearest office location. You can also call the Social Security Administration directly at 1-800-772-1213 and request the form by phone. Once your appeal is approved, the correction typically takes effect within 1 to 2 billing cycles. In many cases, seniors who file early in the year can recover surcharges already paid in previous months. Most seniors never file this form for the simplest possible reason. Most seniors have never heard of it. You have now. That is the entire reason this video exists. Your priority order. What to do before June 30th. Let me pull all 5 together and give you a clear sequence so you know exactly where to start. Form W-4P controls pension and IRA withholding. Available at irs.gov. Download it, work through the withholding worksheet, and submit it to your pension administrator or IRA custodian. Start here if you are receiving monthly pension or IRA distributions and suspect your withholding is higher than what you actually owe. Form W-4V adjusts Social Security withholding, available at ssa.gov. Submit it online by mail or in person at your local Social Security office, essential for anyone whose Social Security is partially taxable and wants to avoid an April surprise, or for anyone currently over-withheld and losing money every single month. Form 1040-SR, the Senior Tax Return, available through all major tax software platforms and directly at irs.gov. If you were born before 1961, this is your designated form. Verify with your preparer that they are using it. If you file independently, confirm your software is routing you to the senior version. Form 8606 tracks IRA basis and protects against double taxation. Filed as part of your annual return. If you have ever made non-deductible IRA contributions or completed a backdoor Roth conversion, this form is legally required. Bring it up with your CPA immediately if there is any history of contributions from years when your income exceeded the deductibility limits. Form SSA 44, the IRMAA Life-Changing Event Appeal, available at ssa.gov. If you are currently paying an IRMAA surcharge and you have retired, reduced your income, or experienced any qualifying life event since the income year Medicare is using to calculate your premium, file this form before June 30th. You do not have to wait for open enrollment. It can be filed at any time during the year. And unlike many tax elections, corrections can be applied retroactively to months you have already paid at the elevated rate. If you can only do one thing this week, if you are currently paying an IRMAA surcharge, begin with Form SSA 44. The monthly dollar impact is the highest of any form on this list, and the correction reaches your account the fastest. If you are receiving pension or IRA distributions and your withholding appears higher than your actual liability, move to Form W-4P next. If you are collecting Social Security and your withholding situation is not clearly calibrated to your current income level, Form W-4, V is your third step. Then confirm with your tax preparer in plain, direct terms that they have used or will use Form 1040-SR for your return. And if there is any history of non-deductible IRA contributions in your past, raise Form 8606 in that same conversation. The one idea that connects all 5. Here is the most important thing I can leave you with. The thread that runs through every single form on this list. The form already exists, the IRS already accepts it, the Social Security Administration already processes it. Your savings are already legally yours. Form W-4P is sitting on irs.gov right now. Form W-4V is at ssa.gov. Form 104-0-SR is available in every major tax software platform. Form 8606 is required by law for anyone with IRA basis. Form SSA-44 has been in place since the IRMAA system was created. Every single one of these forms is real. Not one of them is automatic. The government does not issue refunds for forms you forgot to file. No one sends you a check for appeals you did not submit. The entire structure of the system is built so that money stays exactly where it is, unless you take the step of standing up and claiming what is yours. These 5 forms are how you do that. Do one thing for me before you close this video. Forward it to one person in your life who was born before 1971. A parent, a neighbor, a colleague who recently retired, a sibling who just hit their 65th birthday. The odds are very high that they are missing at least one of these 5 forms right now, and one conversation, one share, could be worth thousands of dollars to them. That is not a small thing. That is a real difference in someone's monthly financial life. Tax law changes regularly, and everything in this video reflects the 2026 tax year based on sources verified through the current date. Always consult a licensed CPA, enrolled agent, or qualified tax professional before acting on your specific situation. The details of your individual finances matter, and getting them right matters more. If even one of these 5 forms was completely new to you today, hit the like button right now. It takes 1 second, and it helps this video reach more seniors who need to see it before June 30th arrives. Subscribe and turn on the notification bell so you never miss an update. And drop a comment below. Tell me which of these 5 forms you had never heard of before today. Or if you have already filed one of them and it worked for you, share how much it saved. I read every comment personally. Your experience helps the next person who finds this video. You were born before 1971. You worked for decades. You built something. And sitting on the IRS and Social Security Administration websites right now are forms designed specifically for people like you, people who earned every dollar of what is waiting to be claimed. The IRS is not going to call and tell you what you are owed. No one is. That responsibility falls on you, and now you know exactly where to go get it. End of script.